Hi guys, Michael here. In this video, I'm going to be going over how there is a housing market debt disaster coming very soon. People are FOMOing in and paying $500,000 to $1 million over reserve, and they're over leveraging themselves, and this is going to create a huge amount of risk for the financial system and for the housing market in the near future. As we always know, history doesn't always repeat, but it often rhymes. And what this housing market right now is sounding like, you could say it sounds like the roaring 20s with everything going up in the stock market and the housing market. And it's also sounding like 2006, 2007, when the stock market was booming and the housing market was booming. But people were taking on too much debt, and they were taking on risky debt because they thought, hey, even though I can't afford the repayments now, I'll just buy a house and I'll flip it in 2 or 3 years for a profit. That is the mindset of everyday Australians and Americans right now, pretty much everywhere around the world. The housing market in the US, UK, Canada, here in Australia and New Zealand are going nuts. But what people will be doing is they'll be over leveraging themselves and putting themselves in some terrible financial positions. So in this video, I'm going to go over the latest data and information on this and the current situation that's happening all over the world, and I'll go over what this means for you, what this means for me, and what we can do to protect ourselves. So first things first, the Reserve Bank of Australia Governor Phil Blow has sent some warnings about the Australian housing market boom. He continues to say, and like all other central banks around the world, in Australia and in the US, interest rates aren't going up. No, they're not going to go up. We're not going to raise them. Because if they did say, hey, maybe, inflation's getting a bit high, maybe we will have to lift interest rates, the stock market would start dropping immediately to price in those further rate rises, and people would start to lose confidence in the housing market, because as interest rates drop like they have 1%, and that means house prices can rise 10%, if they rise 1%, then the housing market can fall 10%. And this also adds to the fear of a debt disaster, because responsible lending laws are due to be axed this month. So don't go anywhere. We're going to get into these risks of what's going to happen if they do axe these responsible lending laws, just as there are calls to actually tighten lending restrictions, like what they did in New Zealand, as property prices have gone absolutely nuts. It went up about 5% in February, and house prices are up 22%. So their Reserve Bank stepped in and they put a cap of 60% LVR for property investors, and owner-occupiers have to have a minimum deposit of 20%. But here in Australia, property investors can still get home loans with a 90% LVR, and first home buyers and owner-occupiers can still get home loans with just a 5% deposit. And as I always say, it is credit that fuels the housing market, and as long as there's easy access to credit, that's what will lift house prices. People are getting too comfortable with low interest rates, and if they make responsible lending laws too loose, then the banks are going to say, look, we can just lend, and if there's any issues, we'll just blame it on the borrower, because now it's the borrower's responsibility or the mortgage broker's responsibility. And it was this kind of loose lending and crazy borrowing that led to the subprime mortgage crisis in the US and led to a complete financial crisis across the world. So we can't get complacent, and we can't just not take this seriously. We definitely have to take these changes very seriously and watch how it affects the market. So an internal Reserve Bank report outlining the negative effects of long-term low interest rates has strengthened the case for retraining responsible lending standards, economists have argued. So it says here in this report that low interest rates for too long, it encourages families to take on too much debt, especially with responsible lending laws being eased. Because most families just go by what the bank says. So the bank says, hey, you can borrow $500,000, and say the family can just afford that. They can just afford $500,000. But then all of a sudden, responsible lending laws are axed, and they can borrow $700,000 according to these new bank standards, but they can't afford it. But they see all their friends going out there buying their dream home, or they go through an open floor inspection. They just fall in love with the property. They don't really run the numbers. They just get all emotional and say, okay, let's go ahead and let's do it. But if too many people do this at once, which is happening right now across the world, and as inflation risk arising, this is putting huge risks to the financial system with debt overload when debt to GDP is skyrocketing. This could trigger a huge debt bomb and completely plummet the global stock market and the global housing market. And something that the Reserve Bank keeps on harping about, they say, is a wealth effect here in Australia. Hey, if your house price goes up 100K, you're wealthier. So they say, are people going to go out there and spend? Well, for me as an example, I know many families in my situation, my house has gone up 100K, but that doesn't make any difference to me. The only way I can access that $100,000 if I go ahead and take on more debt, and means my repayments go up and means my cost of living goes up and it puts a lot more stress on me, or it means I have to sell my house. But if I sell my house and make, whatever, for example, 100K profit, then I have to pay about $10,000 to $20,000 to the real estate agent in commissions and advertising fees. And then when I want to go ahead and buy another house, well, they're all $500,000 around the area as well. So I'm just in the same position. Plus, I'd have to pay stamp duty, which is around 5%. So I'd have to pay another $25,000 in stamp duty. So I think that this wealth effect that they keep on harping about, really, who does it benefit the most? It benefits the governments because they get more revenue from stamp duty. It benefits the real estate agents because they get more commissions. And it benefits property investors and property developers that make more profits when property prices go up. And like I said, it really only benefits those that have multiple properties that can go ahead and take out that equity to fuel their lifestyle. The report the Reserve Bank released also says that high unemployment is the biggest risk to the economy, which we have right now. And also JobKeeper is going to be axed this month, just as a loosening responsible lending laws. So some people may be in a tough position, they've lost their job, they're now no longer getting JobKeeper, and they may take on some payday loans to just get by. And also the ABZ put out a report that how responsible lending laws is going to fuel a debt disaster. And it says here, Catherine Temple from Consumer Action Law Centre is part of a coalition of consumer groups that have written to financial regulators, including the Reserve Bank, detailing their strong opposition to the proposed law. She said axing safe lending laws during a pandemic was risky and would fuel to an already overheating housing market. And that's exactly right. Easing responsible lending laws when there are calls to tighten lending laws in this booming housing market could cause a blow off top. It could make house prices shortly in the short term go parabolic until people all of a sudden can't service their debt, and then it comes crashing down. And here is a chilling statement that she said. And brokers are saying that now it's even getting easier for people to borrow before these responsible lending laws are going to be axed. They said the banks used to assess people to be able to repay the loan at an 8% interest rate. Now it's just a 5% interest rate. And they said also the recent tax cuts has means people's borrowing capacity has increased, and also the paperwork is getting less strict. So the banks, they're already kind of pricing this in, or kind of jumping the gun here, and they've already made it a bit easier to get credit already. But another huge risk to the housing market, and something that we cannot ignore, is rising interest rates. As we've all seen in the bond market in the US and here in Australia, the 10-year Treasury yields have been skyrocketing over the past year. They're up over 1%. And even though the central banks are going to say, no, we're not going to lift interest rates, you can never trust what a central banker says, because they have to cheer on the market. They're like cheerleaders for the market, saying, hey, we're going to keep interest rates low, go out there, borrow. And people borrow up to the max, and people go out there and invest to the stock market on margin, taking huge risk, like what we've seen with the GameStop frenzy. And it makes people very complacent. But there is this risk coming around the corner of higher interest rates. So AMP Capital Chief Economist Shane Oliver worries that at some point down the track, interest rates will rise and people will be unable to pay their mortgages, like I've been saying. He says, with the removal of responsible lending obligations and the property boom underway, the risk is that those lending standards will be eased and people who shouldn't have got a loan will end up getting one, Dr. Oliver said. But what he is saying, it is likely that if lending does get out of control, APRA and the Reserve Bank will step in to tighten lending standards. And if they do loosen lending standards, and then everyone thinks, oh, it's easy money, this means house prices are going to boom. But then all of a sudden APRA and the RBA step in and tighten lending standards, well then that's going to put people that are over leverage exposed, because like I said, easy lending standards will lift house prices, but then they go in there, and if there's a credit crunch, like what we saw in 2018 and 2017 when there was a banking royal commission, House prices in Sydney and Melbourne fell 10 to 15% within 12 months. The house price declines were faster than during the pandemic when they tightened lending standards. And Martin North from Digital Finance Analytics goes on to say that loosening these lending standards are going to put all the risk on the borrower, so that when things go bad, the bank can go, nah, wasn't our fault, or all the responsibilities on him. We can just wipe our hands with it and blame it all on the borrower, because we've seen there's been so much lawsuits against the big four banks recently and have been losing lots of money. So this is definitely a big win for the big four banks. This means, although you're seeing all over the television, there's a boom, 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 you got to get in now, you got to get in there, FOMO's building. This means there are risks building up underneath. And just like in this article, it says almost a third of Australians are 30-day behind on their mortgages. We're having JobKeeper ending this month, job seekers being reduced. We have mortgage holidays coming to an end. Businesses can no longer trade while insolvent. Bankruptcies are rising, delinquencies are rising. What we've had so far is all the good times of the pandemic, I guess you could say, in a financial term. We've had all the stimulus that just covered up all the problems. So we haven't really seen the problems. But now that stimulus is getting taken away, and we're slowly starting to see some cracks in the housing market and the economy. And so what this means is people are being lulled into a false sense of security. The banks and the government and the central banks are all saying, come on in, borrow, come on, get in, because they don't have your best interests at heart. All they care about is GDP growth and the economy growing, stock market going up, and house prices booming. They don't care about the individual, but I do. So this is why I'm sharing this information with you. So guys, don't FOMO in. Don't make poor financial decisions just because all your mates are jumping in the housing market and they're, making big, huge bucks in 6 months. There are risks building up underneath. We may see some of the cracks and some of these battle scars from the pandemic appear later this year or early next year, and interest rates are rising. So you do have to be careful and have to be prepared. And for all my loyal viewers and subscribers still watching, you're awesome. And if you haven't already, please tap that like and subscribe button. I'll keep you all updated on the latest that's happening here in the Australian housing market. I'll put up some of my other videos here. Go watch them all. And of course, I'll see you there.